whatever story you want to tell. What is the bias of this Federal Reserve? And is Steve Rasciuto of Mizuho correct that this Fed wants to cut and is going to do everything it can to reduce interest rates?
Can they, at this point, though, justify it, given the fact that we've seen hot print after hot print when it comes to inflation? That's why people are watching, and Francis put this really well in terms of not just whether it's 2 or 3 dots. 3 dots is what they had in the previous projection. If they move it down to 2 rate cuts for this year, that indicates a sort of more hawkish tone, but also 2025, 2026. Are they seeing their ability to cut rates that significantly materially crimped by the fact that inflation is stickier than they previously expected?
2 challenges. 1, got to try and call the Fed. 2, got to work out what the market's going to do in response to that. And 1, if you'd called things correctly so far this year, I'm not sure you would have got 2, with equities still grinding higher, surging, rallying towards all-time highs, even as we price out Federal Reserve interest rate cuts. And another great example of that, 1, call on a central bank, and then 2, getting the market call right. Bank of Japan. If you made the call this year, we'd get the first interest rate hike from the BOJ since 2007. Would you have the Japanese yen as the worst performing currency in G10 against the US dollar this year? I'm going to guess probably not.
Potentially the weakest going back to 1990 versus the dollar, and in 16 years versus the euro. You take a look at the weakness in the yen. Is it a function of Japan and sort of the dovish message, or is it a function, again, what we heard from Win Thin, of King Dollar and this idea that the U.S. strength has been exceptional and keeps outperforming? To your point about getting a market call right, the narratives are mind spinning. Do you listen to Jay Powell or do you listen to Jensen Huang? And ultimately, this is the 2 polar sort of aspects of this market. Do you focus on technological advancements? Do you focus on fiscal spending? Or do you focus on a Federal Reserve that's playing catch up with all these metrics that aren't cooperating with them?
I'd say the last 12 months, better off following Jensen than Jay over the last year, based on what Nvidia's done in the stock market. Dollar yen right now, 7 days of weakness. Dollar yen very close to 152. The broader price action elsewhere, equities on the S&P 500 just about unchanged and going nowhere. Exactly, precisely unchanged right now. Yields are down a basis point on a 10-year, 427.68. In foreign exchange, the dollar stronger against almost everything in G10 through much of this morning and over the last year as well, year to date. Euro dollar 108.43. Coming up this hour, Wei Li of BlackRock on why she sees rates staying higher for longer than pre-pandemic. Greg Peters of PGM on why he thinks this is a strategic buying zone for bonds. And Nadia Martin-Wigan of Svelin Capital as Brent touches the highest level going all the way back to October. We begin with our top story. 2 days of gains sending the S&P 500 back to another all-time high ahead of today's Fed decision. Wei Li of BlackRock writes in this: we think upbeat sentiment can persist as inflation keeps falling. We stay overweight US stocks and lean into the AI theme as tech drives corporate earnings growth. We see Fed policy rates staying higher than before the pandemic as inflation likely settles closer to 3%. Wei Li, I'm pleased to say, is with us now. Wei, I want to go straight to that inflation call and go back to what you told us at the start of the year, where essentially what you were looking for was inflation to come down a little bit more, then pick back up towards the end of the year. Are we seeing that pickup maybe ahead of schedule?
That's possible, but I would note that the 2 consecutive months of inflation upside surprises came from different sources. So the January bumper print was mostly because of core service, and the February print was driven by hotter than expected goods inflationary pressure. So I think the jury is still out there in terms of if we are seeing the trough of this inflation roller coaster. Our view is that actually there is room for goods deflation to bring inflation down further, but when that runs its course, which is more likely later this year rather than now, service starts to dominate, and that's when wage pressure pushes inflation higher, and ultimately we're looking at the trend settling around 3% rather than 2%. But that roller coaster is for later this year rather than right now, and right now I think the bar is pretty high for markets to abandon this narrative of immaculate disinflation, which is why we're positive on risk sentiment and we're positive on US equities at this moment.
Before we get deeper into equity markets, Wei, how do you think that's going to influence the thinking of Chairman Powell in today's news conference?
Well, it's likely going to be a very balanced press conference and very balanced FOMC. They will emphasize data dependency. They will try to strike a balanced tone. You know, the last meeting, they talked about a sticky last mile. So I am very curious in terms of how they speak to the recent upside surprises in inflation prints. I'm also curious in terms of if they're going to revise growth higher, inflation higher. They're going to start discussing the Fed balance sheet runoff, maybe trimming that a little bit. So lots of things at play. But more broadly speaking, we are expecting dot median to stay at 3 cuts for this year, which is in line with our expectation at the beginning of the year. So now markets finally moving closer to that.
Before shifting to stocks, what duration of bonds do you feel is most vulnerable, given where pricing is and given what you expect to transpire with inflation later this year?
While we have a preference for short end of the curve and also the belly of the curve, so implicitly there is a steepening view over the longer term, and that is more of a fiscal story, right? So if you look at the fiscal deficit in the U.S. Late 2022, we're looking at 3.5%, and now we're getting to 8%, and that servicing cost is increasing, expected to increase even more, the higher rates for longer, and premium needing to come back. So all of that points to higher rates, especially for long end of the curve. But when that kicks in, when that repricing because of concern around fiscal dynamics and that serviceability, that's key, which is why our conviction on the long end of the curve, yields moving higher, it's stronger over a strategic horizon than over a tactical horizon of 6 to 12 months.
Are stocks vulnerable to a hawkish surprise from the Fed, or are they operating according to a different set of rules that really hinge on very different factors than Fed set rates?
But you asked the question, Jay versus Jensen. So I think that's what the stock markets are trying to figure out as well. But if year to date is anything to go by, we have had hawkish repricing of the Fed, like 7 cuts at the beginning of the year to now just 3 cuts, and yet markets are very resilient. S&P is up close to 9%, equal weighted S&P close to 5%, right? So this is not a market that are caving in under hawkish repricing pressure, and the bridging factor, the reconciliatory factor here is the strong earnings, and a lot of the earnings are being heavy lifted by the AI theme, which is why we are positive on U.S. equity market, because earnings are coming in strong and stronger, beating expectation, and we lean into AI because that's where actually most of the earnings momentum is coming from.
Given that way, do you think that calls for some sort of broadening out in the rally are premature, just simply because the gains still are concentrated, not just with magnificent 4, 3, or 2, or whatever people have got whittled it down to, but also only the companies that are most leveraged to immediate benefits from some of this technology?
Well, I think there is room for S&P to broaden out from the very concentrated leadership that we saw for most part of last year, but that can also be thanks to AI. So as we think about sectors like healthcare, sectors like industrials, starting to adopt AI to a greater scale, the leaders within those sectors are likely able to broaden the gap versus the rest of the peers within the sector, because they have economy of scale, they have a lot of data to play with. So we can see actually AI driving broadening out of the rally concentrated in tech so far. So that's one way that it can broaden out. Another way that it can broaden out can be a wild swing of rate repricing, right? So we're talking about 3 cuts now, and remember at the peak hawkish moment of October, markets were still looking at 2 cuts, but we have really seen a wide range of rate repricing, which is also evidenced in the very high elevated rate volatility, the MOVE index. So there's no telling if we could see swing back of this rate repricing, and when that kind of tactical momentum plays out, that could benefit the broader market beyond the AI concentrated theme. But that's so short term, because we have seen wild swing within short periods of time. That's not something that we're positioning our investment views around, but we acknowledge that this can swing within this short period of time.
So Wei, I know you're overweight US equities, but also a sprinkle of Japanese stocks. Can we finish there? The Nikkei 225 is up by almost 20% year to date. It's been quite a run. Can you tell me how the Bank of Japan in any way, shape or form is relevant to that decision?
Well, it's the prerequisite on which the micro story can play out, which is our expectation and rationale behind our Japanese apple. So we upgraded Japan twice last year, and we continue to like it at this juncture, even as it crossed the all-time high last made in 1989. So yesterday was a key event for us to watch. So if they are very kind of hawkish, viewing inflation as a problem, I would be somewhat concerned with our Japan call. But frankly, yes, they hiked rates for the first time in 17 years, but they hiked it in the most dovish way possible, right? So for example, they nominally dropped yield curve control, but they're still saying in case of a rapid rise in long-term yields, they would make nimble responses, adjustments. So if that's not the definition of YCC, I don't know what is. So they really kind of very supportive and accommodative still, and that paves the way for micro positive developments to continue to be reflected in Japanese equity price.
Well, that trade is working out. Wei Li at BlackRock. Wei, thank you. We've been asking the question repeatedly. Where does it leave the call on Japanese stocks if the yen starts to strengthen? I guess we should have been asking, where does it leave the call if the yen carries on weakening? Because we've had 7 days of Japanese yen weakness, getting closer and closer to 152. You know, we hear a lot of guests talk about being long Japan. I was going through the most crowded trades at Bank of America on the Fund Manager Survey when we caught up with Candice Browning yesterday. Long Magnificent 7, most crowded trade, to be expected, 58%. Short Chinese equities, 14%. Long Japan equities, 13%. Maybe not as crowded as I felt, at least, based on that.
Well, based on the fact that people come on and we challenge them to that whole idea, everybody's long Japanese equities, they say, yeah, it just reached a new record high. The first time since 1989. It's not as if we have a long way to go, potentially, with certain companies, Toyota including, that are actually delivering on their bottom line.
Things are changing. They have been changing there for a while now. The Nikkei 225 up by close to 20% year to date. Let's get you an update on stories elsewhere this morning. Here is your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. Israeli Prime Minister Benjamin Netanyahu is set to speak with Senate Republicans in a video call today. This coming just days after Democratic Senate leader Chuck Schumer called for elections to replace Netanyahu in remarks that drew criticism from Republicans, including Senator Mitch McConnell. Israel and U.S. Democrats are seeing a growing rift over Israel's need to enter the Gaza city of Rafah, with Netanyahu saying he sees no way to destroy Hamas without invading the city. Inflation in the UK falling more sharply than expected, cooling to the lowest level in 2.5 years. The Consumer Prices Index rose 3.4% in February from a year earlier. That's slower than the 4% pace the month before. Economists say the data keeps the Bank of England on track to reduce interest rates later this year. Kering shares are plunging. The company warning sales at its key brand Gucci will drop about 20% in the first quarter due to a slowdown in the Asia-Pacific region. The French company is struggling to keep up with rivals like LVMH and Hermes as luxury sales have cooled over the past year, especially in China. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, will the Federal Reserve open the door to higher bond yields?
They only showed 2 cuts for this year. We think that the 2-year will sell off 10 basis points. We think you'll see the curve bear flatten. If they show 3 cuts, the 2-year will probably rally by 5 basis points. Curve will bear steepen.
That conversation up next.
For cover starting from just 50p per month, search HomeServe today. We're on our way.
expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. 11 a.m. on the East Coast, 8 a.m. in the West. Only on Bloomberg Television. Context changes everything.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Green World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Today, the Fed decides.
They are scared stiff of getting this wrong.
And markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data.
We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance. The Fed decides, starting at 1:30 p.m. Eastern. Context changes everything.
Stocks just about turning positive in the last couple of minutes by not even a tenth of 1%. We've been spoiled. All-time highs on the S&P 500 coming into a Federal Reserve that isn't going to cut interest rates today in the minds of pretty much everybody forecasting the Fed. Yields are lower by a single basis point, 427.87. Under surveillance this morning, opening the door to higher bond yields.
But they only showed 2 cuts for this year, so they take out 1 cut. We think that the 2-year will sell off 10 basis points. We think you'll see the curve bear flatten. We think you'll see the dollar rally, and we think you'll probably see risk assets take it on the chin. If they show 3 cuts, as they had in December, and as our economists expect that they will, we think that the 2-year will probably rally by 5 basis points, curve will bear steepen, and you'll sort of see dollar weaken and risk on.
Here's the latest this morning. Bond traders stepping up short bets against treasuries ahead of today's Fed decision, positioning themselves for a hawkish message from Chair Powell. Greg Peters of PGIM Fixed Income writing this: we're still in the strategic buy zone for bonds. True, credit spreads are much tighter on high-yield bonds, but yields on investment-grade indices are comparable to year-end 22 levels, and central banks are in all likelihood done raising interest rates. Greg, I'm pleased to say, is with us now. So, Greg, it begs the question, and if we can, let's go straight to the Treasury market. 430-ish on a 10-year in the last 24 hours, back through 470 in the last couple of days at the front end of the curve. Greg, is that a buy for you looking across the curve at the moment?
Yeah, look, I think we're in the zone, and so whether rates rally or not kind of misses the point, right? It's about the carry that you receive, the yield that you receive, and I think as a fixed income investor at these yield levels, it's a very attractive proposition. So, you know, our tagline for the year is yield is destiny, and I think, you know, you win by just having the yield, the income coming in the door, and if there is a blip in the economy, you finally have that protective measure of owning duration. So I think it's, I don't want to say a win-win, Jonathan, but it's a very attractive investment indeed.
Greg, how do you convince people to say, Greg, I get all of that, but I think yields are going up, inflation's coming in hotter, starting to see commodities break out, crude getting close to 90 again. I think I should wait. I think I can get an extra 20 to 50 basis points further down the road. What do you say to them?
Well, look, I mean, you know, timing the market is always quite, quite challenging. But I think where we are from a starting point matters a lot. And so, kind of the break even of, yield moving higher is quite attractive as well. So, like, you'll never time it, of course, but at the end of the day, at 430 on a 10-year, I think that's a very attractive investment. And like I said, you have that protective characteristics of fixed income if and when the economy does roll over.
Greg, you have something for everyone. Yield is destiny. I want to make a t-shirt that says that. On the flip side, you talk about how fear but not fear itself, and talk about the possibility later this year of a taper tantrum with a negative ratings development for U.S. Treasuries. How does that kind of negative side of things feature into yield is destiny when you're talking to clients?
Yeah, look, I mean, that's a risk factor, Lisa, no doubt about it. I just want to be open and honest. I mean, I think we have a tremendous amount of supply hitting the system this year. There is such a focus on Fed policy, and I do believe the markets were leaning the other way, just really embracing rate cuts way too early. I think we're in a much more natural state today than where we were at the start of the year, but it's a risk, and just want to be, eyes wide open to so much funding of the deficit on the come, you have to be focused on that potential problem.
It's the reason why we focus on auctions so closely here at Surveillance. And the reason why I do care, I do want to go back to this idea, though, that for now, it looks like an attractive buy. At 4.3% on the 10-year, does the Fed matter to you? Does anything that the Fed says today going to shift that view one way or another just simply because the market's moving away from the Fed and the Fed's kind of following it?
Yeah, so I think there's way too much focus on the Fed. At the end of the day, it's about the data. The data matters. Once again, if you rewind the clock, the markets were so obsessed with, rate cuts, and the only way the risk markets could do better is if the Fed cut rates. Well, actually, no. It's about the data. The underlying data is strong, and so
ओके सो अभी यहाँ से एक अच्छा खासा मूव आना चाहिए अपसाइड पे.
more than the Fed. So I think, there's something to do today, focusing on Powell and the Fed, but at the end of the day,
यही लेवल हमेशा से रेजिस्टेंस की तरह एक्ट किया है. तो लेट्स सी इस बार ब्रेकआउट मिलता है कि नहीं.
I want to talk about the BOJ. It is the last anchor around the neck of the global fixed income market being lifted. We've seen the ECB shift, seen the Fed shift. Now it's the BOJ's turn. Greg, when you think about not just the next 5 minutes, the next 6 to 12 months, the next 10 years, what are we going to look like compared to what we did look like over the previous decade or so?
Yeah, so you could see the situation where, Japan rises from the ashes finally, right? And so what we got yesterday, the BOJ is, moving policy out of negative territory, but that's it, right? So you'll continue to see, I think, a weak yen. I think you'll continue to see flows into Japan. There's all this talk around crowded trades, as you were mentioning earlier, around, equity markets in Japan. Most investors have shied away because it's been 2 decades of disappointment. So I think this is a very early stage move in Japanese markets. And I think what you'll continue to see is this much, much lower rate regime relative to anywhere else in the world. And I think that will fuel FDI and push that market higher.
Greg, can I ask you, Japanese investors had to look for income elsewhere. Certain European markets are vulnerable to this trend. I'm trying to work out how those flows are going to develop in the next few years. How are you anticipating that's going to happen?
Yeah, I mean, on the margin, you'll see that, and you've seen that pull back, but very much on the margin. I mean, just look at the interest rate differentials, right? So if you look at yields in Japan relative to anywhere else, or most jurisdictions outside of Japan, there's a significant pickup. So I don't see a fundamental shift. There's a natural home bias for sure, but I think that's more on the risk side, equity side, than it is on the fixed income side. So on the margin, yes, but I don't think it's anything dramatic.
Hey, Greg, thoughtful stuff. Appreciate it, as always. Greg Peters there of PGM Fixed Income. Bit of a clinic on fixed income today. We'll catch up with Steve Major of HSBC in the next hour as well, so look out to that. Jan Hatzius at Goldman Sachs coming on too to anticipate the Federal Reserve. We will be talking about the Fed with Jan. Bit of data as well. To Greg's point, though, this year, this is something that Dutta at Renmac talked about, others too. We talk about Neil way too much, I know. GDP, nominal GDP has been better than expected. Equities have been listening to that noise and trading on it and ignoring what's happening in the bond market. And the bond market would have been better off just watching the data and spending less time trying to guess the Fed.
The data, of course, is a bit confusing, and the Fed's obviously confused by it. The data that they're watching is interesting. Greg talking about labor markets, and we hear that again and again. Do you watch the quits rates? Do you watch the non-farm payrolls numbers? Which ones do you look at?
Up next on this program, Intel winning almost $20 billion in US awards for chip plants in a program designed to reinvigorate the domestic industry. That conversation up next.
Matchmaker, matchmaker, make me a match. At Auto Trader, you could win an electric car. Every month we're giving one away. Just enter for free and be on your way. Insurance and a charger are thrown in too, and we'll even deliver it all to you. Visit autotrader.co.uk/giveaway to enter for free today. Auto Trader, Britain's biggest matchmaker. T's and C's apply. To verify, email brand at autotrader.co.uk.
was around so many powerful people in my entire life. From the time I got married to Robert Kardashian and had a whole ecosystem of businessmen and entrepreneurs and people running studios, and any given day it would be the head of a studio, and just often paid attention without really realizing I was paying attention. And I had a very amazing education. I was a housewife. I was raising 4 kids at home. I had the most blessed situation, but at the same time surrounded by these business situations that I didn't even realize were happening right in front of me, but I must have been absorbing it, because there's so many times I've like brought up in my mind one of those conversations that I had learned from. And so I think I had a very lucky and blessed existence that way.
Welcome to the world of decentralized finance.
You can see the massive gains for the OG crypto coin.
The breakout we have all perhaps long awaited finally realized. We'll see if it sticks.
Bloomberg's covering all things crypto, the people,
There's no question its industry is composed of some bad actors and some good actors.
the transactions,
Volumes have surpassed $24 billion per day.
and the technology.
Stop talking about the technology, start demonstrating the utility.
Bloomberg Crypto, Tuesdays.
All-time highs on the S&P 500 going into the Federal Reserve decision later on this afternoon. Equities pushing higher in the green on the S&P, positive by 0.06%, up by 0.25% on the Nasdaq 100. Plenty of headlines in the bond market over the last few weeks. The 2-year, 10-year repricing higher. Yields getting back through 470 briefly, back through 430 briefly on a 10-year, 428.27 this morning, down a single basis point on a 10-year maturity. On the 2-year, 467.88. A wonderful time on a trading floor with Bank of America and the team just yesterday. Thank you so much for everyone that reached out. A lot of those interviews you can find online, including the one with Mark Cabana of Bank of America. And the point that Mark made, I think, is an interesting one, that maybe this move in equities just opens the door for yields to keep going higher because you're not getting the pushback at all.
When honestly, it's not just equities, it's also risk assets within the credit markets. I was looking at, for example, high yield bond spreads. They're now the tightest, the extra yield over benchmark rates. Now, the lowest going back to January of 2022. This is not a concern about credit risk, even with higher borrowing costs, which raises the questions, why can't that borrowing cost go a whole lot higher with an economy that still is chugging along?
Spreads are tight, stocks are at all-time highs. We'll find out if Chairman Powell in this news conference is bothered or not by financial conditions. Frances Donald of Manulife was with us about 40 minutes ago. She was saying the chairman needs to tell us what he's actually looking at, and we need to work out whether financial conditions are relevant or not, because earlier last year they were, and then later last year, all of a sudden, they weren't.
Is it or isn't it just finger in the wind? Because essentially a lot of people think it is finger in the wind, and it's basically pick your own data indicator that's going to paint a story that feels good at that moment. And so if there is some sort of shift, how do they communicate it at a time where in December financial conditions didn't matter? Maybe now they matter a little bit more.
Does yen weakness matter? Let's turn to foreign exchange. Just turn the page on this market. Dollar yen. Dollar yen right now. 7 days of yen weakness. We have not seen a streak like that since August of 2023. We are back to close to 152 at 151.71. Again, breaking out by another 0.6% or so off the back of a rate hike at the Bank of Japan. Win Thin of Brown Brothers Harriman made out that this isn't going to be a problem for the BOJ. They'll be comfortable with this. And let's wait and see. Let's see what headlines we get from Japanese officials. You know those stories, sources say that they're unhappy about what's happening, then nothing happens. Let's see how many of those we get in the next couple of weeks.
Still, for Japan, though, what's interesting is their symmetry of risks is still they want more inflation. And so this is why I actually think that the Bank of Japan's hand will be called potentially a little bit more if Jerome Powell today has a hawkish message. If the Federal Reserve is concerned about inflation and wants to raise rates, that could potentially cause more capital flows into the U.S. away from Japan, leading to the end to weaken to a point where the Bank of Japan has to pay attention. And that might be the worst risk case for some of the officials that might be whispering potentially off the record to some people who are reporters.
Potentially, maybe at some point in the future again. It's a 3% move over 7 sessions, and those of you familiar with foreign exchange, you know a 3% move in foreign exchange. It's not the same as equities. That's a big move in FX over a week or so. Under surveillance this morning, counting down to the Fed decision at 2 p.m. Eastern Time. The central bank expected to keep rates on hold for a 5th straight meeting, with investors looking at Chair Powell's news conference for clues on the Fed's rate cut timeline. Earlier this month, Powell saying the Fed was, quote, not far from the level of confidence needed on inflation to begin cuts. but further hotter than expected inflation prints, reinforcing the case for caution here going into this. And this is what it's going to be about, that confidence line. How does he phrase the level of confidence that he has now relative to where he was at the start of the year?
Two things that I'm watching based on that kind of idea. Number one, how much do they revise upward their benchmark rate forecast for 2025 and 2026? I want to see that. And number two, how much does he push back or even address the financial conditions question? If he doesn't address it, that will be so dovish, basically saying we don't care about how much the equity markets and credit markets have rallied. If he does address it, it indicates that maybe they're getting a little bit more nervous, that the market is moving in the opposite direction from what they're trying to do.
2 p.m. Eastern, you'll get the statement and the summary of economic projections. 30 minutes later, you'll hear from the chairman himself. Some news on JP Morgan I want to bring you, lifting its quarterly dividend by 9.5%. Following record annual profit and regulators signaling they may rethink proposals for tighter capital requirements. It's the second time in the past year that the bank has boosted its quarterly payout. In the announcement, the CEO, Jamie Dimon, did not provide a reason for the increase. You will hear from him, though, April 12th. That's when earnings season starts to kick off. And can we just reflect on what we heard from Brian Moynihan? The customers, businesses are still pretty strong. But the point on M&A, I think we have to keep revisiting. The fact of the matter is that they are struggling to convince the banking universe, struggling to convince clients to enter into conversations about deals, because even if you agree to a price, agree to the terms, you could be left hanging out to dry for the next 12 months and Washington, D.C. throwing mud at you. Do you want to go through that if you're a large company?
What does a banking executive do with the behemoth that is
अब
Washington,
यहाँ पे
D.C.?
ब्रेकआउट तो मिल चुका है, अच्छे खासा एक बुलिश कैंडल ने ब्रेकआउट दिया है और उसके बाद होल्ड कर रहा है, तो अपने नेक्स्ट रेजिस्टेंस पॉइंट तक उसको टेक्निकली जाना चाहिए.
You know, you may have some legal fees, but you know it might be so good. This is not a good case for them to be making.
You can make a great case, and then you're just waiting for a tweet from Senator Warren and others to sort of pile on. And she's got company in the Republican Party now. This is the issue.
The key question for me is how much will there be some sort of surge in M&A post-election?
Yeah.
Or not? If Ed Mills is right, and basically the policies in either camp seem to be more or less similar to one another. Interesting question.
Let's stick with policy down in Washington and look at shares of Intel rising after the company won almost $20 billion in incentives to expand its semiconductor factories, as the Commerce Department looks to reinvigorate America's domestic chip industry and reverse a production shift towards Asia. The investment in Intel is a key part of Commerce Secretary Gina Raimondo's plan to have the US produce a fifth of the world's advanced logic chips by the end of the decade. Bloomberg's Michael Shepard joins us now for more on this story. Shep, the money, we're finally starting to learn how big these numbers are going to be and who's going to receive them, Shep. How big is this going to be?
This particular award that we're seeing today is significant. It is the first to go out for advanced chip making. They've already doled out a few packages for older generation semiconductors, but this would go to the good stuff. This would go to what the U.S. is really trying to regain and maintain an edge on, and that is the most sophisticated chips that are out there. So the money will go to both production, but also to some research and development. It's concentrated in Arizona, and President Joe Biden is going to be out there later today to make the announcement in roughly the 1 or 2 p.m. hour our time.
Mike, I do have to ask about what Ed Mills was talking about, the idea that some of the defense spending in the United States is being shifted to technology investments because this is the new front for the Cold War internationally. How much is that happening? How much of the defense budget, and where is it going within the tech world?
Well, Lisa, this is a great question because our reporters who've been tracking the budget over the years have seen an increase in investment in technology. Not only in the technology that just makes the Pentagon go from day to day, you know, some of the back office systems, but really the technology that will power weapon systems and things like that, and power how troops are used and deployed, and some of the thinking. We had a terrific piece maybe a week or two ago by Katrina Manson, who looked at the use of AI in warfare and how we're even seeing it deployed on the battlefield today in relation to the Houthis.
Mike, can we talk about the CHIPS Act? Can you tell me the terms that you have to follow to receive this money? What kind of terms are attached? Because clearly that's not free. What do they have to do to attract that kind of capital?
Well, you know, that's a great question, Jonathan. Basically, what they are looking for is they want the companies have to show what they're going to do with it, They're quiet, though, in terms of what they're saying publicly, how the money will be deployed in each individual project, in each individual phase. And they're, for now at least, giving on a preliminary basis access to much larger pots, and then working with the department on an individual basis, how it will be used at the facilities that they're developing. And remember, Intel is looking for this big footprint in Arizona. Part of it will be what will it look like in terms of creation of jobs and being able to sustain those jobs. The other part will be on the technology side. How good will the tech actually be, and what sort of a leap in generation will we get to see?
I think we can all agree we're late to this, Mike. This is something we should have been doing maybe a decade ago when China was talking about Made in China 2025. When are we going to see the results from this effort? How many years do we have to wait?
It may take some time. We are seeing the companies already starting to break ground and make moves. Arizona is one place where Intel is investing. Ohio is another. But it will take some time for them to actually bear fruit on these investments. It takes an enormous amount of capital and a lot of time to build one of these factories known as fabs and actually get it up and running. It requires a lot of people. And Taiwan in particular is one place where they have had this mission to build up their semiconductor manufacturing base. And Taiwan Semiconductor Manufacturing Company, as you know, is one of the world's leaders just because they have made this concerted and decades-long investment in this area.
Just to that point, Shep, how much is this trying to replace Taiwan as the center of chip production?
You know, this is a good question. When we speak to Taiwanese officials or around town and elsewhere, they do bristle at the idea that the U.S. might be trying to elbow them out. From the U.S. standpoint, it is a little bit less than that and a little bit more of bolstering what we've talked about before in this venue about economic security. They don't want to see all of our semiconductor capabilities and manufacturing housed offshore. They're concerned that if, you know, heaven forbid, China makes good on some sort of plan to move on Taiwan militarily, what would happen to the U.S. access to chips? Never mind, you know, all the other fallout from a military conflict. So there is that. And then there is also just the question of the U.S. has long been a pioneer and champion in this area, you know, for decades with the military and space programs from the 60s and 70s. And so under President Biden, they have made, it's one of the pillars of his Bidenomics program, they have really been pushing this revitalization of the manufacturing base to try to bring some of that back here.
Shep, I just have to really wonder about the analog history rhyming. How much is this sort of a redux of Oppenheimer, Robert Oppenheimer, and sort of the whole Manhattan Project and putting tons of money into it to see what they could come out? Is this basically a similar, although technologically focused kind of transition where they're trying to funnel as much money into that to beat in the cyber race with some of the other big powers?
You know, I think that there is an analogy to the idea of the initiative. I think one of the differences is that they're trying to be much more targeted and focused, and they're really trying to bring in, you know, a range of people to the Commerce Department and other agencies to make sure that it gets overseen properly with, you know, on the financial side and also on the technological side in very specific ways. One of the other differences I think we also see is that the money actually has a limit. There's $39 billion in grants and another $75 billion in loans and other guarantees for this program. And if you talk to the Intel CEO, Pat Gelsinger, who is spearheading this big effort to revitalize the company and move it forward, he says the U.S. will very likely need a CHIPS Act too. This investment that we're seeing from the government is really a drop in the bucket compared to what other countries have done with their manufacturing bases. You know, places like Taiwan and Japan and South Korea that have this tradition of, you know, state industrial policy and investment.
I'm shocked that Mr. Gelsinger thinks there should be another act, Mike. Absolutely shocked. Michael Shepard, thank you, sir, down in Washington, D.C. I don't think Pat Gelsinger has ever sounded pessimistic about anything, ever. Do you remember catching up with him a few months ago in Switzerland?
I'm just waiting for his scarf to actually be a QR code. I really wanted that.
That's what it looked like. I remember that,
exactly.
Yeah.
He was so optimistic, and I understand why if he's getting $20 billion of money infused. And of course, he's going to say we need more. And you can make the argument, but of course he's going to say that. This is my shocked face.
If you are just joining us, the headlines crossed a little bit earlier this morning. Intel receiving $8.5 billion in grants, as much as $11 billion in loans to help fund the expansion of its semiconductor factories. Those federal funds expected to begin flowing by the end of 2024. That stock is higher by close to 4% in the pre-market through this morning. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Yahara Hakez. Hey, Yahara.
Hi, John. President Joe Biden and former President Donald Trump swept up more delegates in primary elections yesterday as they set their sights on a rematch in November. Trump won all 5 Republican primaries with 75 to 81% support, while Biden won 4 Democratic primaries after Florida canceled its vote. He received 83 to 91% of the vote. Kansas was the only state with a none of the above option on the Democratic ballot. It took 10%. The Texas migrant arrest law is back on hold. Just hours after the law briefly took effect, a federal appeals court stepped in, preventing Texas from arresting and deporting migrants accused of entering the U.S. illegally. A 3-judge panel intervened after a series of back-and-forth rulings that saw the Supreme Court weigh in. That 3-judge panel meets today. Michael Dell is unloading shares in his namesake computer company for the first time in nearly 3 years. Dell is cashing in as Dell stock soars on optimism over AI. For the past 2 weeks, the founder and CEO has been selling on a near daily basis, offloading more than 4 million shares worth about $465 million. He still owns about half of the Texas-based company. That's your Bloomberg Brief. John?
Yahara, thank you. Up next on the program, crude oil breaking out. That's next.
Billy, we know you had high hopes of uploading your cosplay videos, but your last broadband provider's loading wheel of death crushed those hopes. So you told yourself,
it was just a silly video anyway.
A silly video you only edited 133 times, so stop being silly, Billy, and put full fiber, award-winning hyper-optic broadband in your corner. Now you share that labradoodle cozy with the world.
Ruff, ruff.
Switch today at hyperoptic.com. Available in 64 towns and cities. Winner of Broadband Provider of the Year in Uswitch Telecoms Awards 2023.
The ocean is very much out of sight and it needs help. And so I became a photographer to be able to communicate with a larger audience. And thank goodness I was good at it.
When did you realize that actually photography was your passion and you could make a real difference to our world?
You know, I didn't start out as being a photographer, so it was not until 1990-something, 96, when I picked up a camera and I became a professional photographer soon after. And it's one of those things that it's like learning another language. You learn a few words and then you put a few sentences together, and one day you might be able to write poetry.
Was you were offered a money-losing women's basketball team, and you said, I want to be in the other sports as well. Is that right?
Well, yeah, you know, you got to be smart about this.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
Best question I get all night.
Bloomberg, top experts, great questions.
Equities on the S&P positive by close to 0.1% and counting you down to the opening bell about 90 minutes away, a couple of hours away. Equity futures doing okay. Yields are lower by, let's call it a basis point, 428.66 on a US 10-year. One eye on crude, just backing away a touch, but over the last week, under surveillance this morning, crude oil breaking out.
All the strength you've seen recently, and the consensus range is 70 to 90. Do you really want to be short $2.50 from here? Probably not. So I think we're going to see it bust well outside of that 70-90 range. I don't want to calculate how high we go. It's not my job anymore these days.
It's true.
But I think, you know, the risk is clearly the upside. I think the main point is I want to be long oil and the rest of the commodity complex in this environment.
It's fantastic to see Jeff Curry with a new seat, isn't it, over at Carlisle? I think it's great. I missed him massively over the last couple of years.
We have to get him back in and talking about why so many people are bullish, because frankly, if you look at investors, they're not making the calls on exactly where the oil price is going to go, but they are mostly all bullish.
I'm going to ask him for a call. He's still got what? He's going to offer a price target, surely.
He's not going to offer it. He'll have one, but it's not his job to actually get pilloried for being wrong.
Triple digits, and this is why. With Jeff Curry, formerly of Goldman Sachs, and now of I love Jeff. Jeff, if you're listening, I know you often are. It'll be good to catch up soon. Nadia Marta-Wiggum of Svelland Capital joins us now on her outlook for the crude market. Nadia, I think we need to get straight to this breakout we've seen, not this morning as we pull back, but over the last couple of weeks. Even Brent getting close to 90 again. What's behind this breakout? We've been talking about why it hasn't happened for months. Then just like that, it starts to happen. What's behind it?
First of all, we haven't had inventories building in Q1, so all the market bears can't find those inventories that were supposed to come. Number two, and this is something he touches on, Jeff Curry, it's the whole complex breaking out in terms of commodities. You know, the Goldman Sachs Commodities Index, everything is moving up. Copper, natural gas, and this is when we look at that $90 range. If we get, you know, BCOM breaking out higher, then you get those passive investors buying oil right now that are a little bit short right now. They could be long oil, but short the index, right? So as this commodity index becomes more popular, you get that passive money in, which then propels the fundamentals to where we see them going, which is a much tighter market this summer.
You talked about copper. Copper close to 9K this morning on the London Metal Exchange. I think we broke through that level in the last week or so. Brent crude close to 90 in the last week as well. Are those stories different, or do they point to the same theme? Is that about supply and maybe not about demand?
It is especially about supply. But on the copper side, you know, we've been waiting at Svelland Capital for this move for a long time. And the energy transition story is very important in terms of copper demand. It's been viewed quite negatively because of the housing situation in China. But we need to think about, you know, infrastructure build out, not only completing a house at the last leg of that side of things, right? When we look at the oil side, you know, demand continues to be strong. We expect to see growth in oil demand in China, but the main tightness is really in the refined product space. And this is where we expect refinery runs to be higher this year, year over year, because we need to restock on that side. And that requires more crude to run more refineries.
How much is some of the reporting out of Ukraine and Russia also affecting the price moves, given the fact that Ukraine is successfully targeting a number of different Russian sites, including refineries?
Yeah, in our view, this is a real game changer as the market starts to understand that we're entering potentially the next phase in the war. Ukraine is using Ukraine-designed drones to target specific refineries, hundreds of miles within Russia. That means they can take out refinery units as they wish. Already we have an impact right now in Russia of around 850 to 900,000 barrels per day of refinery outages. That includes refinery maintenance, right? Around 500 to 600 are because of what has been hit. When you take that out of the refinery complex, globally, when Russia's already limiting exports of refined products, we have to look at where is the refining spare capacity in the world, and that is in China. And typically when this happens, we're talking about 1 to 2 million barrels per day of spare capacity. In Q2, China only has 300,000 barrels per day of spare capacity because of maintenance. So that means when everyone comes back from maintenance, June, July, they're going to ramp really hard in terms of what they need to run. And this is where we think OPEC will have to change their strategy, because all of that has to happen at once. Otherwise, we have no gasoline for the summer.
We've seen gasoline prices already ticking higher in the United States. Right now, it's at $3 and about 51 cents, which is the highest going back months. I'm looking right now, the highest since October 2023. How high could it go given the sort of blockade in the refinery process globally?
Well, I mean, we're traders, right? We look there. There's no peak number. It's until it's that demand destructive number. But you know, it depends what the U.S. decides to do about this situation, right? In the worst case scenario that we have Russian refineries continue to get struck through Q2, the ones that have already been struck can't come back online. We then have a situation where Russia is importing gasoline or trying to import gasoline. what can NATO do? They can just blockade that, right? And so that is where we can have a limit on that gasoline price increase, because then Russia is not trying to take in product that's available for the rest of the world. Even if NATO were to do that, though, we still see upside to gasoline prices from where we are now, especially because the U.S. economy is looking quite all right.
Can we wrap things up by what you said, with what you said
So
about
स्कैंडल को
OPEC? You
क्लोज
said
होने में
OPEC
अभी
will
भी
have to do
6
something.
मिनट बाकी
What
है
do you mean by that?
and we are seeing a pullback.
We believe it's not only they can bring back barrels in Q3,
जहाँ से
they will
ब्रेकआउट मिला था उस लेवल के
bring
नीचे
back barrels in Q3 to prevent
गया
the
ज़रूर था
market
बिटकॉइन,
from hitting
लेकिन अब
a
फिलहाल
demand-destructive
एक अच्छा
number
पुल
in
बैक दिखा
terms
रहा है
of
फिलहाल,
refined
और
products.
5
We
मिनट्स
expect
6
already in
मिनट्स
June,
बाकी है, तो
for
लेट्स सी.
refineries to ramp up, and that will probably promote a little bit of cheating within the group. So come the meeting, they'll decide, with the market as it looks now, that they need to bring back at least 500,000 barrels per day of production, maybe up to 1 million.
You said Q3. There's an interesting thing happening in Q4. It's the US election in November. You remember the midterms. We talked about the SPR as if it was the strategic midterm reserve. Do you remember that conversation?
Oh, yeah.
Not my phrase.
I know.
It was someone else's. But Nadia, there was big pressure on the Saudis then to increase output because it was believed that the president wanted lower oil prices going into the midterm elections. Now, I just wonder if it's in Saudi's interest, in their own interest politically, to do what you're suggesting they will need to do in Q3. How will the politics play into that decision?
Absolutely. The Biden administration will push this, and the Chinese will need it as well. So it's both sides of their consumer pool. So it just makes sense.
Honestly, to me, this is just fascinating. I just wonder how much this is essentially going to cap the prices. Is this basically a cap to how high prices could go?
Well, it's a solution that doesn't solve the entire problem, because the tightness is in that refinery sector, right? But it will help ease things. So we can actually get through the summer.
Nadia, appreciate your perspective on this. Nadia Martin-Wigan there at Svelland Capital. And why we're seeing a breakout in commodities, not just crude, but copper too, what's behind it, supply side story, and perhaps why OPEC will need to act in Q3. But the politics of acting in Q3 going into Q4, I think it's less obvious. It's hard to read the tea leaves on this one going into the end of the year.
You think that OPEC Plus is going to want to stick it to the United States?
Well, when we say OPEC Plus, who do we mean? We're talking about Riyadh. We're talking about Saudi Arabia. All I can do is lean on the experience of what we saw going into the midterms, and there was some real tension then between this administration and the Saudi Arabia Kingdom and Riyadh. And I just wonder if that tension's going to be there in quite the same way in a few quarters' time.
Especially if they support one candidate more than the other, and they want to sort of put their thumb on the scale, because this is one of the cleanest ways to do so, considering that when oil prices tend to be higher and gas prices are higher, people tend to feel worse, and that affects elections.
It's going to be part of the calculation, conversation, let's put it that way. To Nadia's point, though, China needs it too. And I think maybe that's the thing that tips the scales if it needs to happen. But let's see where we are. I mean, the crude is a difficult thing to forecast. And as I often say, if you want to make a fool of someone, ask them for where they think crude's going to be in 3 months' time, and they'll probably look a fool.
The U.S. is the swing factor in terms of production, seems to be shifting. And the story is shifting beyond that. And that, I think, is something significant.
The third hour of Bloomberg Surveillance up next. We'll catch up with Steve Major of HSBC, Jan Hatzius of Goldman Sachs, David Lefkowitz of UBS. A fantastic lineup going into the Federal Reserve decision later this afternoon.
The linear business is not going anywhere. The sports business is moving is going to figure itself out between digital and linear. It's an unbelievably healthy market. They all have to be in it. They all want to, every single one of the players want to be in it because of the audience. We have two assets in the sports business that don't have are year-long, don't have a season. I don't believe prices are going down. You're going to figure out the bifurcation of the rights and give things up, not give things up.
How long do you think it is before Netflix actually jumps into sports?
You know, they're in sports right now, but they just do the shoulder program.
Yeah.
I think their point of view, and you'll ask Ted tomorrow, is we build up we don't want to be in the bidding of rights and then not have any long term. So I'm not sure. They did bid on Formula One, but ESPN got it. So I think that was a smaller package, meaning smaller economics. So we'll see.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
I'm Alex Rodriguez. I'm a former New York Yankee and played professional baseball for over 20 years. Almost that entire time, I was thinking about business.
And I'm Jason Kelly. I've been a business journalist at Bloomberg for more than 2 decades. And across my career, I've covered everything from the Olympics to Wall Street.
From Bloomberg, this is The Deal. Each week, you'll hear us in conversation with business icons.
This show will explore deal-making across sports, media, and entertainment.
This is very fancy for a podcast.
If I knew what it was going to be, I'd have put everything I had into it.
I get asked more about our relationship than I do my wife. You know what I'm saying?
This is a show where we talk with big-time athletes and executives about the wins, the losses, and lessons learned along the way.
This show is called The Deal.
The Deal?
The Deal.
The Deal.
That deal.
The Deal.
Huge deal.
Who dug this up? One of y'all's in trouble.
This is Bloomberg.
The Fed has latitude that a lot of places don't have, that they can be hold the restrictive and let the economy really catch up.
If financial conditions are easier, then there's less easing for the Fed to do.
They're telling you we want to cut rates. The problem is the data is not letting.
There's no doubt that financial conditions have eased rather dramatically in the course of the past few months.
I think they should, as a matter of long-term strategic policy, move back to a neutral rate because the economy doesn't need them to be tight.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The third hour of Bloomberg Surveillance begins right now, live from New York City this morning. Good morning for our audience worldwide. It is Fed decision day, and going into that decision this afternoon, equities all-time highs, adding some weight to it this morning. Credit spreads very, very tight, and trying to work out what on earth Chairman Powell is going to say in this news conference at 2:30 p.m.
Honestly, what people are looking for is some pushback to market activity, as well as maybe some walking back of this desire to cut rates, because right now in the market there is this belief that the Federal Reserve wants to cut rates regardless of data. It's not really cooperating.
He only spoke a couple of weeks ago at the semi-annual testimony down on Capitol Hill in front of the House and then the Senate, and basically said we only need a little bit more confidence. So what's changed? Has the hot CPI, hot PPI story changed that?
Yeah, there hasn't been that confidence. There hasn't even been a little bit more confidence. And some people are now saying that if you look at the year-over-year comps, it's going to get really complicated to really get down to the levels that they want to see by summer. That said, how much are they concerned about the asymmetric risk of a downturn happening very quickly and all at once? And that, to me, is going to be a key question. Do they still see that as a bigger risk than runaway inflation?
He framed his reaction function in January pretty clearly. He basically said that strong growth isn't a problem and we can respond to weak growth. I wonder if that story's changed in any way, shape or form. Also have to discuss how relevant this is to equity markets, given how many cuts we've priced out so far in 2024, and the fact we're sitting here in March, which was meant to be the meeting they were cutting interest rates at, by the way, only 3 months ago. And here we are with stocks at all-time highs, and that's not the conversation at all. We're not talking about cuts at this meeting, and stocks are doing okay.
If your head is spinning, join the club. And I do wonder at a certain point if, yes, stocks can keep rallying because of the names that are not vulnerable to interest rates. Big tech. They have huge cash flows, and they don't necessarily have that much debt. Do you see the bifurcation continue, the broadening out that everyone's been looking for, get delayed and delayed and delayed and delayed, just simply because those tend to be, those other 492, 93 names tend to be the ones that are more leveraged to some of these rates. This is sort of the dynamic that everyone wants to die and just isn't going away.
We should stop talking so much because we've got a fantastic lineup this hour, which I'll get to in just a moment. Equity's doing okay, positive by 0.1% on the S&P. Coming up this hour, we'll catch up with HSBC Stephen Major on his bullish Treasury call. Jan Hatzius of Goldman Sachs on why he thinks inflation will fall in time for a June rate cut. And David Lefkowitz of UBS saying the equity rally has room to run. We begin with our top story. All eyes on the Federal Reserve decision coming at 2 p.m. Eastern Time. Bond yields rising this year as data comes in hotter than expected and the timing of rate cuts is pushed back. Stephen Major of HSBC staying bullish, saying this: in anticipation of rate cuts, we take bullish duration exposure in Europe and stay at mildly bullish for treasuries. Steve Major, that's with us around the table. Steve, good morning to you.
Morning, John.
Can we start with that mildly bullish story for treasuries? Yeah. Why mildly bullish in the face of a bit of a sell-off we've seen so far this year?
Well, mildly bullish is not all in. All in is full-on bullish, and that's why Europe is ranked above the US in terms of possible easing and performance from duration. But we can't let go of this view that yields are going to be lower, not higher, by year end. And I get they've been sliding up the last week or so, and I mean, the context is important. We've come a long way from the peak in yields in October. The inflation peaked in June 2022. The market changed its directional view on rates in October 23. The Fed pivoted a couple of months later. It seems to me that they're not going to change their mind. The next move is down. And in the meantime, we know it's either unchanged or down for policy rates. And therefore, the trade is sit in the belly of the curve. If not treasuries, you take IG credit. And if you can't take those, then you, what's it called, T-bills and chill. Is that what they say over
That's
here?
what they're saying stateside, yeah. T-bills and chill.
I've been here long enough now to
Picking
get
up
the
the lingo.
Yeah.
Let's go further out along the curve, get away from the belly and go out to the 10-year say.
Yeah.
What backs up this call at the moment that yields at the end of the year will be lower, not higher?
So if you took the most hawkish individual in the December dot plot, you get a longer run equilibrium rate just below 4, and you get very little rate cuts in the next year or so. So if you just took that as a path for rates, it's difficult to get the 10-year yield much above 4.5 on our calculation. And you'd be really going some to get to 5. So just knowing that right-hand tail of the distribution is sort of in at 4.5 and change, I quite like the idea of being long. Now, it's very difficult to time this, and that's why the best trade, which I think everyone seems to be doing, is owning the corporates, taking
अब देखना है कि क्या इस जोन को BTC क्रॉस कर सकता है, बिकॉज ये जो डाउनफॉल आया है उस फॉल का ये 0.5 गोल्डन जोन है, बेसिकली इसके ऊपर हमें शार्प मूव दिखाई देगी.
It's superb. So I think that's what's going on. If you're in T-bills and they're maturing, you've got the option to roll them again or go and buy something else. Now, the thing is with buying the 10-year Treasury, you drop 100 basis points in yield. But at least if you go to IG credit, you can sit and wait. And I think that explains the tight credit spreads. I don't think we can infer too much reason in the credit spread as to say something about default probability. I think it's the all-in yield that people like. They can't get enough.
I was very excited to speak with you today because for so many years, I remember all of the people who are calling for some huge sell-off in treasuries, and I'd get the major letter, and it would come out and say, you're all wrong, yields are going lower, because basically we're looking at a low inflation, low growth reality. That was before the pandemic. A little bit after the pandemic, it sounds like your thinking has shifted somewhat, given the fact that you're not aggressively bullish in treasuries. Has it? Has the neutral rate shifted? Has something about your view of the world changed?
The quote that John lifted is for our March asset allocation, so it's the monthly, right? The view hasn't changed. Our year-end forecast is 3.0. That seems a long way from here, but believe me, once they start cutting, the market's going to move quickly, and this is the issue that people have. Is that it's very dangerous to be short of treasuries.
Super move आ रहा है Bitcoin में.
A very interesting narrative to justify being short of treasuries. So the minimum you can be is neutral and small long. I think that the growth narrative has been the biggest challenge.
मैंने अपना टेक प्रॉफिट 65,000 के आसपास रखा है.
US exceptionalism. It's the fiscal.
और फिलहाल दोनों पोजीशन में मेरा जो प्रॉफिट है वो ऑलमोस्ट 3000 GBP एंड 2400 GBP चल रहा है, तो ऑलमोस्ट के आसपास रनिंग प्रॉफिट.
The average over that period. Does anyone really think that 3% real GDP is going to be the case for the next 10 years? Because it looks to me that that's very unlikely.
Well, but maybe not. Maybe the growth story isn't going to be there. But there is an argument for the inflation story to be there, especially given the election, especially given more protectionist policies, especially given some of the issues that are not going away with respect to wages and just the fiscal money that has been, pro-cyclical, which is sort of counterintuitive. How do you dismiss all of that?
I don't want to dismiss it, Lisa, and you're right. The last bit on inflation has been sticky, but the big picture, where we've come from since June 2022, it looks like a symmetrical reversal. So it went up and it came down. We're not quite on the target rate yet, but they don't have to arrive at the target before they cut rates. That they would be almost irresponsible to wait until after they've hit the target. I can't dismiss what you're saying. I don't dismiss it, because to me it's about probabilities and scenarios. So the sort of no landing scenario whereby inflation stays sticky and high, growth ticks along, that says there's no rate cuts this year. In which case 2-year yield should be 5.25, 5.5. I get it. 10 should be 4.5, 4.75. That's sort of where they would land with no landing. But soft landing is where we are today, and we've got this risk on the left-hand side of the distribution here of a hard landing. Has it really gone away? This time last year, people were cancelling meetings with me. That's an easy thing to do anyway. But
Banks were
no, because it was the regional bank stress. Right? People say to me, "What does a hard landing look like?" Well, the first thing is this interview doesn't happen.
इस लेवल का ब्रेकडाउन नहीं आना चाहिए. It should continue the upward
For
move.
a good few weeks, we had the smell and the look of a hard landing. 2-year yields were screaming down towards 3%. Right, so I'm not saying I know anything that's going to bring that back, but it's just about probabilities. It seems to me that we're leaning a bit towards no landing, soft landing, stagflation. That's what it's all leaning towards. And to me, bonds protect you in case that's wrong and you go back the other way. So that's the explanation, Lisa. I can't let go of the fact that I think rates are going to be coming down. And when they come down, the market will price.
देखो यहाँ पर एग्जैक्टली बॉटम पे मैंने BTC को बाई किया था. इस ब्रेकआउट पे मैंने यहाँ पे फर्स्ट बाई किया. जैसे ही ट्रेड मेरे फेवर में गया और जो ये फर्स्ट रेजिस्टेंस था उसको ब्रेकआउट किया, यहाँ पर मैंने सेकंड क्वांटिटी बाई की और दोनों क्वांटिटीज़ को मैंने होल्ड किया है.
Can we talk about what it depends on? And the fact of the matter, to Lisa's point, that we've got this sort of pro-cyclical fiscal policy in the US now where deficits are massive with unemployment south of 4%. Does that matter to the ultimate call?
I was here this time last year and we discussed it, and yields were pushing towards 5 for the 10s, and it was on the supply-demand imbalance. Looking back with hindsight, maybe the Treasury made a misstep with the amount of coupons they issued at that time, given the GDP, the downgrade, the inverted curve. I mean, it's easy for me to sit here and say so afterwards, but it looked like that was a misstep. And it was addressed in the November refunding. Now, I think that on the whole, supply should not matter to your yield forecast. It can matter to your near-term tactical view if there's an auction coming up or there's some kind of thing. But, the supply impacts term premium when there's a surprise and there's an imbalance. In the longer run, I think the stock of debt, the huge stock, and let's remember it's virtually doubled in the last 2 administrations under both of the last 2 presidents. We're at close to $27 trillion of marketable securities. That's double early 2016. So that weighs on future growth, and that pulls the R-star down. Everything else being equal. The way that happens is through debt servicing. So the way that bond supply deficits feed into the way the bond market behaves is 2 different things. There's the imbalance which can hit the term premium, lift it up, short term, and there's the longer term, what it does to the equilibrium policy rate. And I think there's unambiguous evidence that the stock of debt weighs down. So it opposes the positivity of the population growth and the near-term impulses that might come from AI, etc. But the debt stock weighs the other way.
Yesterday, just to put a bow on all of this, Mark Urbana of Bank of America was saying that maybe bonds should take a message from stocks that keep flying, and that it shouldn't be stocks taking a message from bonds. do you push back? Do you saying that actually stocks seem to be listening to a risk that's getting baked into bonds, which is why yields are not even higher?
That's a great debate. It's an interesting insight. Why not? We're always looking at new ways of valuing bonds, but it seems to me that the yield on the 2-year Treasury, you can see quite robustly and justify it based on the path of the short rate. And so if it's 470-ish, it's reflecting a Fed that cuts a
ये
couple
हमेशा का
of
प्रॉब्लम है
this year.
मेरा जो अकाउंट है वो
That's
यूएस
basically
ओपन
right.
के टाइम
Now,
पे
that's a
हैंग हो
difficult
जाता
number
है.
because it affects the 5s and it affects the 10s. Now, I think equities seem to be taking
Let me try to relog in.
from what the bonds are telling them, so the rates are coming down. I think bonds are purely priced off of the short rate and its path, so I don't think that they're priced due to equities at all. But it's an interesting debate. I mean, I'd like to see how we could use equity risk premium to influence our valuation on bonds. I don't think we can. It strikes me that it goes the other way. Unambiguously, it's bonds to equities, I think.
Steve, this is awesome. We'll continue this conversation. Steve Major of HSBC is going to be sticking with
Okay.
us. Let's get even
तो
update
जो
on stories
रीटेस्ट
elsewhere
करने के बाद जो ब्रेकआउट चाहिए वो
this
ऑलमोस्ट आ
morning.
रहा है हमें.
Yes, hey, Yahara.
Hi, John. Boeing is warning regular scrutiny and
मैंने इस छोटे से ब्रेकआउट पे यहाँ पर बॉटम पे कुछ क्वांटिटी बाई की थी.
the company's CFO telling a
उसके बाद जैसे ये फर्स्ट रेजिस्टेंस को टेक आउट किया, कुछ और क्वांटिटी यहाँ पर मैंने बाई की और इन दोनों क्वांटिटीज़ को मैंने होल्ड किया है. छोटी क्वांटिटी है तो यहाँ पर ज़्यादा रिस्क नहीं है और फिलहाल मेरा अच्छा खासा प्रॉफिट चल रहा है. तो जब प्रॉफिट में है तो वी कैन जस्ट सी कितना ऊपर जाएगा. आइडियली अगर मेरे को स्कैल्पिंग करना होता तो मैं इसी लेवल पे या इस जोन पे मैं बुक कर लेता, बट अभी यहाँ पर मैंने अपना टारगेट बढ़ा रखा है. तो अभी मेरा जो स्टॉप टेक प्रॉफिट ऑर्डर है वो अराउंड 65,000 के लेवल के आसपास है और फिलहाल BTC है अराउंड 63,750. तो लंबा टारगेट रखा है, देखते हैं अचीव कर पाते हैं या, क्योंकि यहाँ पर अच्छा खासा करेक्शन हमें दिखाई दिया है BTC पे. तो एक्सपेक्टेशन है कि अगर BTC को और ऊपर जाना है तो एक अच्छा खासा करेक्शन हमें दिखाई दिया है. पुल बैक, अच्छा खासा पुल बैक मिल सकता है और BTC 4-5,000 पॉइंट्स का भी मूव दे सकता है और ऊपर जाना है तो एक
Yahara, thank you. Up next on this program, a shaky
पुल बैक,
Japanese
अच्छा
yen.
खासा पुल बैक मिल सकता है.
Because it was so well televised, and the Japanese have been very defensive for the last 18 months during the hiking cycle. That in reality, this is not that consequential of a move.
Dollar yen higher for 7 consecutive sessions. That is a weaker.
To build the electric vehicle of the future, you need partners, mining partners, technology partners, education, supply chain, energy. What if one partner could do it all? That partner is Ontario,
क्या
Canada.
BTC इस
with
लेवल
all
के
the
ऊपर
critical
निकलेगा?
minerals to make
Let's see.
electric vehicle batteries. 65,000 STEM graduates per year. Industry-leading IT clusters. A fully integrated supply chain, powered mostly by cutting-edge low-carbon energy sources. Ontario, your innovation partner.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
DOJ or other authorities.
Could face bigger challenges next.
Was going to keep Green World Cup. This is a three.
As the economic picture
Covering the intersections of Hollywood, Silicon Valley, and beyond.
Today, the Fed decides.
They are scared stiff of getting this wrong.
The markets are just primed for the big green light.
Trust Bloomberg to bring you the fastest coverage and exclusive analysis, including Powell's press conference.
We want to see more good data.
We're still seeing sticky inflation.
How dependable is the data?
How long does it need to be good? 6, 7, 8 months?
Tune in to Bloomberg Surveillance, The Fed Decides, starting at 1:30 p.m. Eastern. Context changes everything.
Live from New York City, 1 hour and 12 minutes away from the opening bell. Equity futures on the S&P 500 shaping up as follows. We are just about negative by 0.03%, going nowhere after going somewhere this year, and that somewhere is higher to all-time highs going into the Fed decision later on this afternoon. And the surveillance this morning, a shaky Japanese yen.
Because it was so well televised, and the Japanese have been very defensive for the last 18 months during the hiking cycle, that in reality, this is not that consequential of a move. BOJ almost like needs the Fed to ease now or ease soon because they'll do a lot of the work for them. But if not, then you have a risk that this 150 numbers is a big deal on the dollar yen.
Here's the latest this morning. The yen is at risk of sliding back to 3-decade lows against the dollar after the BOJ ended negative interest rates without clear guidance on further hikes. Steve Majors with us of HSBC, with us here in New York. Steve, got to talk about this. First move from the BOJ, first hike since 2007, and proving not to be so consequential. The yen moving in the other direction. How are you reading developments in Japan?
Maybe it is consequential because maybe it opens the door up for the next step, the next move. Because if you were scenario playing, role playing before this event, you would have said, imagine a scenario where they went all in, when they did rate hikes, end the yield curve control, end this, that, and the other, really hawkish, and dollar yen went up. And actually that seems to be what's happened. So to me, the totality of the decision and the outcome in the asset markets is the measure of success. So you have to look at all the different details in what they did, and then how all the asset markets play out. And they're watching this closely. I would say that net, it looks like there's room maybe to do some more of something. Now, from a JGB perspective, maybe it means yields can keep going a bit higher. Dollar yen is that's probably not what they want to see.
Well, that's what we're getting to. Sort of to define success, I need to understand what the objective was.
Yeah.
Surely the objective wasn't to see a weaker Japanese yen off the back of this.
The key performance indicators for this one would be not to break anything or make any mess. It's a bit like any big decision from any central bank. First stop is don't make a mess of anything. So in that regard, it's okay. But it just seems to me that it's not really over. There's much more that can be done. The fair value for JGBs with this rate move and the changes on the yield curve control could be nearer to 100. And it's interesting that it's the currency that moves, and that tells you that maybe investors are putting their views through the FX markets more than they are through the bonds at the moment.
So a lot of people are saying that the Bank of Japan is not going to be bothered necessarily by this move in the yen. Do you disagree?
I think they'll be delighted just to have got rid of negative rates. So in that sense, I totally agree. They're not bothered at all because if their objective was to get the rate up without making a mess of anything, then they achieved it. But I think it's the totality of the asset class response that matters, and that takes time to look through. It's taken them how many years? 17 years to get here, and it's step by step. So I think it's conditional, Lisa. I think that their analysis
एक अच्छा खासा रिवर्सल आ रहा है सारे क्रिप्टोज में, तो देखते हैं कितना बड़ा बाउंस बैक हो सकता है.
That will help frame what they do next.
What was interesting to me was a lot of people were saying that maybe if the Bank of Japan ended negative rate policies and actually tightened more significantly, all of the Japanese investors who had been pouring their cash into U.S. credit markets, into European markets, would come home, and that buyer base would not be there on the same level. Do you see that as a potential likelihood, or is what we're seeing what we're getting, which is essentially the dynamic is kind of the same?
I think that the Japanese investors are still very happy to hold dollars, and there's such a big yield gap between the two. That's the thing. For there to be a change in the direction of the yen, clearly more has to happen. If you told me today that policy was being shifted in a way that dollar yen would head back towards 140, then that changes everything. It changes all the hedging strategies, but obviously they haven't done enough to change the direction. So
Superb.
I'm not saying this for sure, but it strikes me that the outcome of this could be that there might be more moves and more iterative steps, especially on the JGB side.
Which raises this question about the threshold for today's Fed meeting and how hawkish Fed Chair Jay Powell would have to be before you see a move in the yen that would actually cause the Bank of Japan to say, wait a second, maybe we need a second step.
Yeah. I think that's unlikely, but given what we've just seen, why not, though, Lisa? Given if we'd sat here, if we'd sat here last week and called higher dollar yen on the basis of what we've just seen, it would have been an outlier. So why not? Let's go with it, right? So Chair Powell goes hawkish again and says it was a mistake. What I said before, he's not going to say that, right? The one thing you can say for sure, you know that he's not going to say.
Powell's capable of going off script.
He's not going to say.
Not like that.
This we can guarantee that's not going to be said, right?
Yeah.
Steve, just Steve, can you reflect on the previous decade or so in this fixed income market? I was in Europe, we were there together, we used to talk about negative bond yields, and Lisa, what did we get up to? 20 trillion? Some ridiculous number of negative yielding assets. What was that period? How would you describe that period? And for those that maybe have just joined the industry and weren't living it, how would you describe that period to them?
Well, it was an experiment in monetary policy, and it was obviously a scary time because the policies were there to address the risk of deflation. The counterfactuals, we don't know what would have happened without some of these policies. I think they get a bad rap, negative rates. I'm not saying I'm a fan or anything, but it's just that they get a bad rap. And what else were central banks supposed to do? Honestly, so I look back at it and I think it was an experiment, and it might have had some quite serious unintended consequences because, well, it shouldn't have been a surprise that asset prices went up so much on the back of this.
How would you judge the success, though, of them?
Well, as I say, it's the counterfactuals. So how many people would have lost their jobs?
Okay, so BTC अभी अपना CPI जोन में एंटर कर रहा है, तो यहाँ पर एक कुछ हल्का सा रेजिस्टेंस फेस कर सकता है या थोड़ा टाइम स्पेंड कर सकता है इस जोन के अंदर.
Otherwise, and that's a really important thing. You can't measure just how important that is for society. So if we just look at negative rates and say, oh, look what they did, they created all of this asset price bubble and all this, that's not, the full analysis is going to look at the real economy and especially employment.
And how much worse it could have been. Steve?
Yeah, exactly.
Fantastic to see you. It's good to catch up. Steve
Likewise,
Major of HSBC. Just remind me that price target, 3% 10-year yield?
Yeah.
That's the yield target year end on a 10-year? Okay.
He looks slightly in pain.
You're going to join us before year end?
I'll be happy if you'll have me.
Of course. Always. Always. Coming up very shortly, we'll catch up with Jan Hatzius of Goldman Sachs, looking ahead to that Fed decision a little bit later on this afternoon. And we'll see if Chairman Powell enters the news conference, sits there and says, Bramo, I got it wrong.
Yeah, that's not going to happen. But stay tuned because maybe he will. Maybe he'll come out and say, sorry, guys. Whoops.
The risk factor in the minds of many is whether that median drops from 3 cuts to 2. We'll see in the projections that we get at about 2 p.m. Eastern Time. Mike McKee's going to break that decision down. We'll get a preview from Mike in just a moment. Then we'll catch up with Jan following that. From New York City, this is Bloomberg.
The way we express ourselves is more than just the music we make. We've created everything from our logo to tour date social posts like these. Whatever you're passionate about, there's more than one way to grab people's attention.
investors to invest in all question. What
percent
बिटकॉइन अपना आज का इंट्राडे CPR सेटअप एंटर कर रहा है, CPR जोन। यहाँ पर थोड़ा सा इसको पेश करने की जरूरत है, लेकिन देखिए अगर इसको क्रॉस करते हैं
Hey, it's Benji from All Good Folks. If you love our music and you want to support Upbeat's amazing... Hey, it's Benji from All Good Folks. If you love our music and you want to support Upbeat's amazing... Hey, it's Benji from All Good Folks. If you love our music and you want to support Upbeat's amazing...
जैसे कि यू कैन सी ये एक रेशन जोन है, तो इस जोन में या तो हमें रिजेक्शन मिलेगा या तो फिर इस जोन में विल हैव टू कंसोलिडेट, थोड़ा बाइंग सेलिंग दोनों दिखाई देगा यहाँ पर. एंड उसके ऊपर अगर ब्रेकआउट मिलता है इस जोन के ऊपर, तो वी कैन सी अ गुड मूव इन BTC, एक्सपेक्टिंग टारगेट्स क्लोजर टू 67,500. ब्रेकआउट मिलता है इस जोन के ऊपर, तो वी कैन सी अ गुड मूव इन BTC, एक्सपेक्टिंग टारगेट्स क्लोजर टू 67,000. पर जो भी है, बिफोर द US Fed न्यूज़, I would prefer to book out my profits. जो भी है, before the US Fed news, I would prefer to book out my profits. जैसे कि you can see ये एक रेशन जोन है, तो इस जोन में या तो हमें रिजेक्शन मिलेगा या तो फिर इस जोन में we'll have to consolidate, थोड़ा बाइंग सेलिंग दोनों दिखाई देगा यहाँ पर. एंड उसके ऊपर अगर ब्रेकआउट मिलता है इस जोन के ऊपर, तो we can see a good move in BTC, expecting targets closer to 67,500.
Amazing community of artists. Upgrade to premium today and help us keep creating great new tracks for you.
Hey, you're currently listening to 92 Elm on Upbeat. This is one of hundreds of tracks that you can access and download when you upgrade to Upbeat Premium.
It follows one of the most synchronized hiking cycles that we've seen, in recent memory. And I think that speaks to the fact that there was a global common shock to
ऑलराइट गाइस, तो मैं फ़िलहाल तो इस ट्रेड को होल्ड कर रहा हूँ एंड देखेंगे 43,300 के नीचे मेरा SL है, ट्रेलिंग SL है। तो अगर इसके नीचे आता है और सस्टेन करता है तो मैं यहाँ पर अपना पोजीशन प्रॉफिट बुक कर लूँगा।